Flipkart is strapping on its running shoes for another shot at the quick commerce race. Earlier in March, the e-commerce giant announced plans to turbocharge its same-day delivery services across 20 cities. Flipkart's latest attempt at cracking the hyper-local, hyper-delivery challenge comes within 2 years of scaling down its 90-minute Flipkart quick offering, calling it unsustainable. Now, Flipkart's return to the racetrack and lining up besides quick runners like Blinkit, Instamart and Zepto is making us all question why again. Why now? Well, quick commerce players in India have turned criticism into conviction. They've been able to sustain the COVID-led momentum that received between 2019 to 2022 by registering a 77% growth in GMV last year. And this is despite 2023 being a slow consumption year, which led to nominal growth of the overall e-commerce market. As per Redseer, as of 2023, the overall quick commerce GMV stood at 3 billion, pretty much equally split between Blinkit, Instamart and Zepto. Now, they've only scratched the surface. JM Financial says their combined GMV could surge to $45 billion once they catch the fancy of India's affluent shopper base, about 30 million households whose purchase patterns QCommerce players have mastered, and accordingly are now offering a wide selection of inventory and experience, including jerseys during the Cricket World Cup, roses and bouquets on Valentine's Day. These have all turned out to be big revenue churners. In fact, the quick runners have ventured into e-commerce territory with electronics, home appliances, fashion, lifestyle, cosmetics and more, while unlocking a lucrative distribution channel for large FMCG players and D2C brands. Now, this has meant that the average order value and revenue, commissions, dark store utilization are all rising while bringing down costs, enabling the quick commerce players to display strong unit economics. 2024 is the year when the top three players expect to turn EBITDA profitable. Dipinder Goyal says Blinkit will create more shareholder value than Zomato can over the next 10 years. Sriharsha Majeti says Instamart can be 50 times the size of food delivery, which is slowing. Zepto's Aadit Palicha has made the boldest statement yet, underlying the topic of the discussion on the show today. In a LinkedIn post, he writes, 2024 will be the year people realize that quick commerce represents another Amazon, Flipkart level outcome in internet in India. Now, do remember, ONDC is also gaining steam in the background as e-commerce goes hyper. So hello and welcome to Young Turks, India's longest running show on startups and entrepreneurship. I'm Shereen Bhan, and joining me now on the program, Aadit Palicha, co-founder and CEO of Zepto, and Anshoo Sharma, the co-founder and CEO of Magicpin. Gentlemen, many thanks for joining us here on CNBC-TV18. Aadit, let me come to you. We heard premature obituaries being written about quick commerce when quick commerce came to be launched in India, and suddenly the mood has turned. Now everyone seems to be talking about how quick commerce will be the death knell for e-commerce as we know it. Explain to me what has transformed or what has led to this flip in conviction.
Well, firstly, Shereen, thanks for having me. It's always lovely being on this show. And to give you a sense, I think we had conviction in quick commerce since day one, purely because customers told us that they love the product. And when you get that depth of product market fit and the level of retention that we saw, right, where we were getting retention rates organically without coupon discounts or incentives that were higher than food delivery, ride sharing, and e-commerce. It was best in class. And when you have that quality of retention, getting to profitability is relatively easy. And to give you a sense, having that kind of customer uptake, we had conviction that we were going to get to the throughput per square foot that we needed in our dark stores to get rent low enough as a percentage of sales where we'd be able to turn profitable. We had conviction that we were able to drive average order values up because customers are so sticky on the product, and giving them more categories to actually buy into, was more successful than even we imagined. And we had conviction in businesses like advertising, where we had access to, customers at the point of purchase with high intent search data. And we can use that intent in that customer level segmentation to give FMCG brands, the likes of Unilever's, Procter & Gamble's, Coca-Cola's of the world, fantastic high ROAS or high ROI advertising, and that's a highly profitable business for us. So we've had conviction since day one. We've been telling people. I think people are now slowly starting to realize. And look, I think the reason why people are starting to realize, to give you a sense, we're in a position where Zepto is going to go from 0 to $1.5 billion in sales in 36 months from launch, EBITDA positive. Right? We're going to be the fastest consumer company in the country at a high TAM to get to $1 billion plus in scale and get to EBITDA positive in 36 months. There's no better return on equity story that's ever existed in Internet India. And when you see those numbers, right, that's when it becomes very clear that this is not only a crazy TAM business with a high market opportunity, but it's also going to be the fastest business or vertical of business to turn profitable, at least in high TAM consumer internet.
Well, there are lots of claims being made here on the program there, Aadit. But, let's try and break those numbers down a little bit. And I want to pick up on where you left off in terms of profitability as well as the addressable market, Aadit. And let's talk about profitability. And what we have seen all quick commerce companies from Blinkit, even now to Zepto, do is charge customers for the convenience that you provide. You've just announced a platform fee, not announced, but you have now started to levy a platform fee as well. Take me through what is likely to be the trajectory on the customer end in terms of handling charges, platform fee, convenience fee, call it what you like, and the road to profitability on account of all of this.
Shereen, it's a great question. Look, to give you a sense, I'd actually go with a little bit of a different narrative because we also launched Zepto Pass 2 weeks ago, and we got 1.4 million subscribers on Zepto Pass in 14 days. And Zepto Pass gives customers unlimited free delivery. It gives them access to incredible pricing on products. And so actually, if you look at it from our perspective, we are getting less and less reliant on delivery fees. The majority of our volume is going to start coming from Zepto Pass from customers that are getting unlimited free delivery. So I think the philosophy of Zepto is to turn profitable with better levers than just overcharging the customer. Sure, we have things like platform fees and handling fees that are relatively minimal. But if you compare us with other verticals like food delivery, we're very, very under-indexed on delivery fees even today, and we're still getting close to EBITDA positive. And you can see that with Zepto Pass, right? Zepto Pass gives customers unlimited free delivery, and we've gotten over 1 million subscribers in the first 2 weeks. And to give you a sense, I think the way that we are actually able to get to profitability while still retaining value for the customer in the form of low delivery fees is through levers like supply chain cost reduction, right? Getting better sourcing leverage, getting more throughput per square foot in our backend warehouses, getting more line haul utilization, getting better forecasting excellence so we can reduce the wastage of perishables, getting a different vehicle mix and the types of utilization that we get from our last mile delivery partners, and even the manpower productivity in our dark stores, right? There's a lot of core supply chain excellence that we built out and cost reduction that's put us in a position of advantage where we can actually pass value back to the customer and still get close to EBITDA positive just 36 months from launch.
Before I get Anshoo into the conversation, Aadit, give me a number. You talked about cost reduction on account of the supply chain efficiencies and all the other stuff that you've done in terms of dark store utilization, etc. What is that number? How much have you been able to cut down on costs over the last 36 months?
Yeah, so look, I think we will be in a position where if you look at FY24 for us, I mean, we went from, in our first full financial year, we started in July of 2021. And by FY23, which ended in, March 31st, 2023, we had already done 2,500 crores in effectively what was our first full financial year. This FY24 is our second full financial year. We should cross 5,000 crores in sales, right? And at the same time, you'll see our PAT has improved meaningfully. You'll see probably a PAT that's come down, or PAT is like a percentage loss will have come down by half while the business is continuing to go. I'm obviously talking in percentage terms. So, you'll see that. I think that's one. And then number two, in terms of, costs on the supply chain side, I'll keep it relative, obviously. Wouldn't want to give absolute terms to our friends, our sort of competitive friends. But I think we've got, in terms of last mile cost, year on year, we're down over 33% right now on last mile cost per order. And we've got, on wastage, we've brought down wastage by 70% since the beginning of last year. We've got more sourcing leverage. Our margin has expanded by a few hundred basis points year on year. And most importantly, our advertising business, we're now clocking hundreds of crores of advertising revenue. So those are all tangible numbers that have moved the bottom line.
Yes, and the advertising revenue is opening up as a big stream of ancillary revenue for a whole bunch of companies, including Zepto, as we just heard there from Aadit. But Anshoo, let me address this issue with you. Aadit gave us a sense of what they've been able to do over the last 36 months and why we're now seeing the skepticism being replaced with conviction on what quick commerce will mean for India and India's consumption story. And it's working differently in India versus other markets, including some of our neighboring markets as well. I'm just looking at the numbers. and let's talk about Blinkit, for instance. Aadit gave us a sense of Zepto, but Blinkit average order value is up from 553 rupees to 635 rupees in Q3 of FY24, doing 6 lakh orders a day. 70% of stores have seen contribution positive. 20% of stores are at a 5% contribution margin. Anshu, what do you believe has really led, again, to this big change, this big shift as far as quick commerce is concerned? Because the likes of Flipkart, etc., the big boys entered the space, exited, and now returning because they believe that they can ensure that this is a viable business, but they didn't a couple of months or even a couple of years ago. What has changed?
Shereen, thank you so much for having me here. It's always wonderful to be in this conversation. I'll start by answering the question. A lot of it is to do with exceptional execution. And then Aadit might make it look simple, but it is not really. So the reason everyone was skeptic was good. Right? It's a complex supply chain, and there's so much that needs to be done. But Zepto, Blinkit, and Sharma, they've done a fantastic job. There's just no doubt that execution has perhaps made it look like it's easy, and more players who would come in, they would have to build the same capability in being able to be successful at doing this. The other thing, now having said that, now we are on the other side of this. We are never first party. And I'll tell you a little bit about the context here is that India's retail is $1 trillion, right? That 90% of that retail is offline, and it's built over a century. So while for certain segments of customers in certain categories, there would be these opportunities by itself will be very viable in large businesses. The larger opportunity around retail in India and digitizing is still phenomenal. So, and as more and more technology is becoming available, being able to bring millions of local retailers in our country online becomes more and more viable. And these retailers provide their own set of values, whether it's assortment, the prices, the familiarity, and a bunch of things that are associated with that. So my sense is that this execution has shown that there is a business model that exists in quick commerce as we know it. However, having said that, the retail ecosystem and the offline retail coming online through programs like what Magicpin does or what can happen via ONDC is by itself a many times bigger opportunity, which is also starting to come together now.
No, you're absolutely right, and I'm glad that you pointed that out. So let's just talk about the ONDC because and what that could potentially do to transform the retail landscape, as you pointed out, Anshu. And you were one of the first to get onto the ONDC bandwagon. Take me through what that experience has been like and what you foresee with more players coming on board.
So we started with something very simple. We put our retailers, and we have 1.5 lakh retailers that we put on the network, and then nothing much happened for a while. But then we realized there are missing pieces to the puzzle. We created a SaaS-like offering similar to what Shopify does and started to give it to large, what ONDC calls buyer apps. These are largely large demand surfaces like Paytm, Ola, now Tata Digital. And that simplified the consumer journey. And once that started to happen, then you could start to see thousands, like tens of thousands of orders, and now 100,000 of orders started to come via the network to our merchant partners. So that piece is now getting built. And while with any new system, and especially this system is more complex because the order is hopping across multiple organizations to actually get delivered. But as more and more standardization is happening, it's becoming seamless, and the experience is high quality. The retailers are contributing. They want more avenues to be able to sell from more demand pipes. And the economics of this model are just inherently stronger. Just one part which I'd say the potential of what this can become is that any large demand surface can be readily converted into e-commerce, provided that these ONDs in a box like tools exist and retailers can start to bring that together with large demand side apps.
One of the other very interesting aspects of the quick commerce evolution and very short period of time has been the kind of explosion that we've seen through the distribution pipes of quick commerce channels like yours, companies like yours. I mean, the belief was that it would be the groceries and the staples that would be out of the pipes right up front. But today, I mean, electronics, home appliances, fashion, lifestyle, cosmetics. I mean, the SKU enhancement has just been diverse and deep.
Yeah, absolutely, Shereen. I think if you look at sort of the categories that are growing rapidly on Zepto today, you'll see categories like, for example, toys, one of the fastest growing categories we have on the platform, right? Beauty and cosmetics. We've got low ticket jewelry, right? Those sort of few hundred-rupee bangles, rings. They sell especially well during event periods. Even if you look at things like fast moving apparel, right? The likes of excellent brands like Jockey, and even sort of appliances, hair dryers, switches, faucets, all of these things are selling incredibly well. So we're just, we're happy to see the demand. I think once people experience quick commerce, there's no going back. They get addicted to that buying flow. And more importantly, I mean, I think if you've got, today we've got over 20 lakh people that open up the app every day. We're the fastest growing, internet platform in the country. And so is quick commerce in general as a category as well, right? And we're a platform that grew 150% plus year on year on a base of thousands of crores of scale, and we're still growing multiples every year, right? We're not growing in percentages, we're still growing in multiples. We should go clock well over 1,000 crores, obviously well over 100% year on year growth in FY25 as well, as things stand. At least we're hopeful. So when brands see that level of growth and that level of adoption this efficiently, they jump onto the opportunity. So we had this phenomenal pipeline of brands that are coming onto the platform with interest to join. And we've got a very strong demand pull right now with the tailwind there. The last thing I'll say is there are also new categories that people aren't indexing on, like meat. Meat and seafood for us, we launched our own private brand of meat, Relish. It's within a few months, 4 months effectively, it's become a 150 crore brand, and it's growing 20 to 30% a month. We think in 12 to 15 months this can become a 1,000 crore brand, and that's an in-house meat and seafood brand, right? So it's not just beauty and cosmetics and apparel. I think there are these other big ticket opportunities where we can really sort of consolidate. I mean, we can really consolidate them and become a horizontal e-commerce player. So yeah, we've been positively surprised by the demand, and all of these new categories are incremental to profitability. They're higher AOV and higher margin than baseline FMCG.
Aadit, that's an interesting point that you mentioned, and let me get you to build on that. You talked about this in-house meat and seafood brand that you've been able to incubate and grow. Is that going to be part of the growth strategy, creating more private labels and building those out as well? And then how do you not get seen as competition for the brands that you're carrying?
It's a good question. The way that we look at it for certain categories, right, like meat and seafood, where we feel we can add disproportionate value to the customer, we have very strong sourcing and supply chain muscle. We built out one of India's largest fresh fruits and vegetables supply chain. We do over 5 lakh units a day of fresh fruits and vegetables through our back-end supply chain that's in-house, right? We go directly to 3,500 farmers across the country with a network of collection centers and distribution centers, and we're sourcing fruits and vegetables directly. So we had the muscle of sourcing perishable products, managing the cold storage of perishable products, and even managing the forecasting excellence of perishable products to bring down wastage as much as possible and make it a profitable category for us. And we were able to use that muscle and say, hey, meat and seafood is an opportunity where we can add disproportionate value, given the DNA of the company with fresh fruits and vegetables. And so that was an opportunity where we saw disproportionate value. If you look at the other core FMCG categories, we don't look at, let's say, competing with the large partners on the platform, because we feel like they've already done a phenomenal job serving the customer use case, right? The likes of a Unilever or a Procter & Gamble or a Dabur, where you've got sort of already fantastic products that are well established in the market. But we see there are white spaces that FMCG hasn't covered when there's a big opportunity on the table, right? And that's where we are investing in private label capabilities. So you'll start seeing that grow in FY25 pretty rapidly on Zepto. We should get to, we've taken some, go ahead.
No, very quickly, which are those white spaces that you intend to focus on, and what's the outlook in terms of launching more categories over the next year or two?
So we're going to launch more categories. We've already launched 5 categories in the past 90 days. And look, I think there's, people say there's an opportunity to compete with Amazon and Flipkart. That, potentially is on the cards, but the way that we look at it is the existing business is so large and the opportunity is so big, we'd rather just put our heads down and focus on that. To give you a sense, we're only 5x away from DMart's scale, which is a $30 billion company. And we're growing 2 to 3x every year. And DMart is growing 15-ish% year on year, adjusted for goods inflation. So, we could be a DMart scale company in the next 2-3 years. And that's an opportunity we want to focus on. So yes, we can compete with Amazon, Flipkart, launch a lot of categories. My core focus is cracking the big, high frequency, low ticket categories that are really giving us a lot of scale. And down the line, we'll see what happens. But there could be an interesting opportunity horizontally in more categories. But right now, we're deeply focused on the opportunities at hand and the new categories that we just launched.
Aadit, I have to give you full points for confidence. We could be a DMart scale company in the next 2 to 3 years. That's the big statement coming in here from Aadit. From Aadit Palicha. But Anshoo, let me come back to you. You know, to Aadit's point, and I think you alluded to that. Is there space for e-commerce, quick commerce, for the kinds of models that you're hoping to build out as well on the back of ONDC and so on and so forth, given the fact that, you know, as the Bloom report recently showed us as well, that the consumption, the true consumption class in India is still small at 30 million. And then, of course, the aspirational Indian, the hope is that that pie will grow. But, you know, we're still talking about, you know, actual consumption class of 30 million. Is there space for everyone?
There is absolutely. I think the existing market for e-commerce is that $1 trillion market, right? And it's becoming more and more tilted towards experiences that people want to have, the right kind of specific niche use case that they want to have, as India's disposable income is growing up. And I think we would see that players who are able to, whether it's first party, like what others is doing, or whether people like us who are able to bring the existing merchants that users are familiar with online, they would stand to start to see the volumes come through that. In fact, like even in our case, we've doubled twice in the last 2 years. We were 4x of our scale versus what we were 24 months back. And given the way our business model is run, the inventory is carried by the merchants, right? We don't solve for that. We solve for experience for the user. We solve for the logistics. We enable them to be able to participate in India's large and growing digital economy. And there's very keen interest from these merchants to be able to be there. If you look back, right, you look back a decade, the offline retail ecosystem has been under threat. Organized retail came, everyone said, what will happen to this retailer? Then e-commerce came, everyone said, what's going to happen to this retailer? 90% of retail continues to be offline, right? So we are long on the local merchants and saying that we would digitize them, bring them online, and the consumers know them, they're familiar with them, they provide a specific use case. So to that extent, yes, there is a clear opportunity for both the new internet models to exist and serve a specific need and a segment, and similarly, the local retailers in our country also being able to participate in this growing online economy.
Well, one thing is for sure that for many large brands, for many large FMCG companies, the muscle, the moat was really distribution. And what we are seeing very clearly happen with what Aadit is doing at Zepto or what Anshoo is doing at Magicpin is that no longer is as unpenetrable of a moat. So that is something that people will need to worry about, that kind of disruption that is taking place. Aadit, very quickly, you know, you gave us a whole list of numbers. IPO when?
Yeah, you're putting a lot of pressure on me, Shereen. But look, I think there's a good amount of growth on the table right now, and you know, I think long story short, you know, we would be excited to tap public markets if we're able to raise capital and a return on equity. I mean, and raise capital and deploy that capital and return on equity accretive way. Take this business to a very high TAM grocery outcome. I think public markets might be excited about that. So, you know, we are currently tracking towards, you know, 18 to 24 months from now. We're building out a lot of the infrastructure we need to go public. So 18 to 24 months, hopefully. But please don't, you know, quote me in 18 to 24 months saying, where's the IPO? Business is dynamic right now.
No, I understand that. We won't hold you to that number, but that is the timeline that you're working with, an IPO possibly 18 to 24 months down the line with all the caveats attached. Anshoo, Sharma and Aadit, it's been an absolute pleasure. Many thanks for joining us to talk about the many changes that we're seeing in India's quick commerce story as well as retail landscape and what companies like yours are trying to do to leverage the evolution. Thanks very much for your time. We'll speak with you shortly again to find out what else is moving in the market. That's a wrap on this edition of Young Turks. From all of us here on the team, goodbye and many thanks for watching.